Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. We've got an hour left to go in the trading day. We are seeing green arrows across the board right now. The Dow up more than 200 points as it looks to end on a positive note for the first time in 7 sessions. The S&P 500 up 49 and the Nasdaq up 218. In terms of sectors we're watching today, tech regaining its footing. The sector up about 2% today on the back of some big gains led by Meta. Shauna?
All right, well, it is the final trading week, the first half of the year, and it certainly has been a whirlwind for investors. Fed policy has been front and center. Aggressive moves from the central bank. It kept the market on edge with Wall Street trying to guess what the Fed is going to do next. And stress in the regional banking sector, well, that added to market jitters. 3 banks failed, prompting concerns about a widespread crisis. And that's not all. The debt ceiling drama down in D.C. was another big risk that investors had to manage. But through it all, a recession has yet to materialize. In fact, the AI frenzy fueled massive gains in tech. The Nasdaq on pace for its best start to the year that we've seen in about 4 decades. Here to parse through what all this means for the second half of the year, we want to bring in David Lebovitz. He's JPMorgan Asset Management Market Insights Managing Director. David, it's great to see you. So certainly investors had their fair share of news and headlines to digest during the first 6 months. How does this set us up for the second half of the year? What should we expect?
So I think that there are a couple of things that investors are going to be focusing on in the second half. Obviously, inflation and Fed policy are very much at the forefront of their considerations. But I think lingering in the background today and something that will really come to the forefront over the course of the next few months is the question of recession. Clearly we've started out this year better than expected from an activity standpoint. Some of that has to do with, the fact that Europe avoided a recession. Some of it has to do with the fact that China reopened. Some of it has to do with the fact that the labor market remains very tight. But we are beginning to see signals that some of those things are beginning to cool off and fade. The backup in initial jobless claims, the backup in the unemployment rate, anecdotally, consumers using their credit cards more, saving less. And so I think we're going to learn a lot about the growth story that, to the point that was just made, equity investors have very much been willing to look through. I think that's going to be the main focus during the second half.
So when you think about the potential for that recession, how much downside do you think investors should be looking at right now? Sure, that cloud has been lingering for some time, but it's been a question of how severe it's going to be when it comes.
So I think that the recession question and the market question are arguably two different ones. We do think that any recession, if it were to materialize today, would look relatively average. And that's not to say that we wouldn't feel it, that the unemployment rate wouldn't back up, that we wouldn't see a broader deterioration in the 6 variables that the NBER uses to evaluate whether or not a recession has occurred. But a lot of our clients seem to be suffering from recency bias and, focusing on 2008 or 2020 as kind of what they expect if we were to have a recession. And we think, again, it'll look more like what we've seen over the past 70 years on average, as opposed to what we've seen the past 2 times around. Now, the question around the market and what happens to equities as they begin to price in a slower growth or potentially recessionary environment, I don't think it's wildly out of touch to say that retesting the October and the June lows is in the cards if we see that deterioration in growth, and particularly if we see that deterioration in growth pass through into corporate profits. But we struggle to see material downside beyond that. So the bottom line is that it's going to be a volatile couple of months here as we get more clarity on exactly what any sort of economic downturn might look like. And again, we think that markets will begin to reflect that reality a bit more than they are today.
So, Dave, that then leads to the question of how investors should be thinking about this just in terms of their positioning right now, because given the fact that tech was such an outperformer, so much of the gains really attributed to just over a handful of stocks, what does that mean then for some of the leadership maybe that's best positioned to withstand some of the volatility? So
from our vantage point, the key word for the second half and probably into 2024 as well is going to be optionality. We don't want to tether ourselves to anything that's too far out in the future. We don't want to make big bets on things that we can't, necessarily foresee with any sort of clarity. We like the idea of owning equities and bonds that return cash to us relatively quickly so that we can then take that cash and turn around and do something with it when the opportunity arises. I will say we came into the year with a view that tech was going to be a good place to be. That enthusiasm's faded because the Nasdaq's up 30% so far year to date. But if we were to see a pullback in those names, that would definitely be a place that we'd be looking to step in, because I do believe that these are not your father's tech stocks, right? They're more defensive than what we saw in the late 90s and the early 2000s. So leaning a little bit more into value today, shorter duration on the fixed income side, leaning more into growth and longer duration assets as we get more clarity and when those opportunities present themselves.
David, you could certainly argue that there's a little more of a value play, especially in the big tech names, but there has just been this incredible run-up that we have seen, all fueled by this excitement around artificial intelligence. I'm just curious how you view that. Is it sort of a mini bubble? Is it investors sort of grasping onto any optimism in the concern and in the broad context of the headwinds that are coming through on the macro side?
So I think longer term, I mean, artificial intelligence, it's going to change the way we all work and live. The question is, when is it going to change the way that we work and live? And I do think that investors may be a bit over their skis in the current environment, expecting these productivity gains to materialize effectively overnight, whereas we see the runway here as being a bit longer. And so it definitely will help boost growth longer term. But I think that investors, I wouldn't call it a mini bubble. I'd say what we're dealing with today is more FOMO, right? It's the fear of missing out. It's the idea that these are the companies that will lead us to the other side of the AI revolution. First of all, that's a really big bet to make. I'm sure some of them will be around, but perhaps not all of them, and at least not play the role that investors seem to be pricing in. And so I think investors need to be nimble and they need to be flexible. They don't need to bet the farm on a handful of names, thinking that that's going to be what gets us to a more productive AI-driven world. So long term, we view this as having significant potential. Short term, I'm viewing it with a bit of skepticism.
Well, David, one of the themes certainly of the first half of the year was inflation, where the U.S. stands. Well, if you take a look at what's happening overseas, the ECB President Christine Lagarde saying that the fight against inflation is not done, that inflation still remains too high. And the perspective that this is a global story, what do it mean for investors here in the U.S.? How are you seeing those developments overseas and the actions that we've seen from central banks around the world affecting traders here in the U.S.?
So I actually think that for the first time, well, we've seen it over the past 12 months, but prior to that, we hadn't really seen a synchronized tightening cycle in 15 or 20 years. And so I think that to an extent, people in the U.S., investors in the U.S., can take a cue from what's going on abroad. Not so much from the ECB, where they've been relatively clear and kind of stuck to what they've laid out, but more so from the Bank of England. I mean, the BOE came in and surprised with that 50 basis point hike the other week because inflation is not coming under control. And yes, headline inflation in the United States has come down nicely as a lot of the base effects from Russia's invasion of Ukraine have rolled out of the calculation. But core inflation, super core inflation, right? Core services, ex housing, those numbers have been range bound for more than 6 months. And so squeezing that last little bit of water out of the inflation sponge, I do think is going to be more difficult than a lot of people expect. And what you're hearing from central banks in the US, in Europe, and in England is that the risk to interest rates remains to the upside. These guys are not done tightening because they don't want their legacy to be that they let inflation get away. And I would go as far to say that with respect to the Federal Reserve, they've already made one policy error, right? They started too late. They're not going to want to make two. And that's going to keep them acting conservative in the fight against inflation.
So, David, when you say the BOE is taking the lead, I mean, does that suggest that you think that the Fed should keep its foot on the pedal, that they shouldn't continue with this pause? Because there is the other side of the debate, which is to say, look, how long is that lag factor? And is there a risk in the Fed moving too quickly yet again when they haven't seen the full impact of their tightening so far?
So there's always risk in the lag factor, but the problem is nobody knows what the lag factor is. And so it becomes this game of speculation. And, again, interest rates are a very, very blunt tool for managing an economy. And what I think the Fed is kind of spooked by is what happened in the 1970s, where a very wishy-washy approach to monetary policy was taken. First Chairman Burns was tightening, then he was easing, then he was tightening, then he was easing. And because he couldn't stick to one approach, inflation ended up becoming a structural issue. I think that the Fed and other central banks recognize that mistake was made and they don't want to repeat it. And so to them, erring on the side of caution and potentially knocking the economy into recession, if it means solving the inflation problem, is far more palatable than taking their foot off the brake prematurely and allowing inflation to once again begin to rear its ugly head in a more significant way. And so I think, again, the risk to rates is to the upside. The Fed is not done. They've said they think they're going 2 more times this year. I think that needs to be the base expectation for every investor.
David, if the Fed isn't done yet, if we do see this another rate hike, at least one more before the end of the year, this risk of recession that you've been talking about, what does that mean then for the jobs market? Because the jobs picture has held up relatively well, very well, really, up until this point. Is that going to start to change? And I guess how material of a change do you think we'll see?
I think it is going to start to change. And I think that that's where the lag in terms of interest rate hikes and the impact on the economy is right now the big question, because the Fed's done a lot. And everybody's looking for the labor market to cool, but it's just not cooling the way people would expect. And so to me, the question around the Fed and more so what gets them to cut rates is really dependent on a broader deterioration in the employment situation. To put it differently, the unemployment rate needs to go up enough that the Fed begins to prioritize a dual mandate rather than singularly focusing on inflation. Once they begin to have a more balanced approach, I think that we can expect them to begin to ease policy, but not until the labor market deteriorates and everybody's waiting for that shoe to drop.
David Lebovitz, great to get your perspective here. JPMorgan Asset Management Market Insights Managing Director. Thanks for taking the time.
Thanks.